Disney has tapped its former CEO, Bob Iger, to return as head of the company for 2 years, firing his hand-picked successor, Bob Chapek. It is a stunning shakeup that represents a shocking end to a bitter power struggle between Chapek and Iger. For more on this, let's bring in Citi Managing Director Jason Bazinet. Jason, you see this headline cross in the late hours of the evening over the weekend coming into an abbreviated trading week. What goes through your mind?
Well, I think stunning. I mean, a big surprise. We spend our days speaking with institutional investors about Disney all the time. No one on the institutional side was calling for this. None of their shareholders are calling for this. So this was a proactive move on the part of Disney, and that's just very surprising.
Jason, this is what we call a boomerang CEO, and we've seen countless times success stories and not success stories. Of course, Steve Jobs returning to Apple, turning that company around. You had Jack Dorsey return to Twitter, not necessarily doing that. Do you think this will be a successful turnaround for Iger these next 2 years? And what does that turnaround look like?
Well, let me just remind you and give you the context of this. The original plan, right, was for Disney was to complete the Fox acquisition, to launch the direct-to-consumer apps, and then pass the baton to a new leader to essentially execute the plan. And Mr. Chapek is known for having very strong execution skills. The really interesting thing, if you own Disney stock and it's down a lot, I would actually argue it has a lot less to do with Disney not executing. It has much more to do with the shift that we've seen across the street where investors just simply will not stomach operating losses. They're demanding profits. And so if you look at Disney, what's really shifted with the stock is the buy side went from doing some of the parts, where they were valuing the DTC business on a per sub basis, as they did for Netflix for a decade. And they just said, we're not doing that. If you're losing money, we're not going to put any value on the business. So if you took Disney today and you removed the $4 billion that they lost in the DTC business, you're paying like 16 to 18 times earnings, depending whether you use Friday's close or where Disney stock is trading now. Said another way, you're getting the DTC business for free. So what does the turnaround? Sorry, go ahead.
I was just going to say, Jason, then that implies that Chapek was actually doing potentially a good job, or at least strategically was doing fine, even if the environment was perceived to shift, which again raises the question about what Iger is going to do differently.
Right. Well said. So I think there's sort of two options that are here. Number one, they may feel like they need to sort of lower the 2024 expectations that they've given for the street, right? They laid out sub numbers, and they may know they're not going to hit those. Or they may know they may not hit the glide to profitability or break-even economics on the DTC business by the fourth quarter of 24. If you're going to make an announcement like that, you're going to want to have someone of Mr. Iger's stature make that announcement to sort of make it more palatable. That's one option. The second option is that they may know that they need to do more M&A. And if they do more M&A in the space to essentially capture synergies to accelerate the path to profitability, the market will just digest that more readily if Mr. Iger, as a very long story track record, well-liked, is going to deliver that message. So those, I think, are the two things to sort of look for.
So, Jason, success under this latest Iger regime would be the return of profits and more consistent results, potentially some M&A, but does it also include getting rid of or spinning off an ESPN?
No, we're very much against spinning off ESPN. Remember, I think that was called for by Third Point. And as soon as they came out with that, we just said that's the dumbest thing ever. The reason is ESPN, there's two important things. One, it generates a lot of their cash flow today, which is going to fund the pivot to DTC. But the second thing that's equally important that doesn't get enough airtime is ESPN actually has the potential to be a global business. ESPN today is really a U.S. business, and the reason is very simple. The U.S. is very unique globally in that there is a middle layer called a sports channel that exists between the consumer and the sports rights. What happens outside the United States is the distribution firms, the cable, telco, satellite firms, buy those sports rights directly, which doesn't leave a role for a channel like ESPN. But if you abstract it, what Disney is embarking upon with a direct-to-consumer business is they're very much like a cable company or a telco company or a satellite company. And so So they should not spin it off because A, today it generates cash flow, but B, there's a potentially much bigger global opportunity with ESPN once you leverage the internet for distribution.
So Jason, in a down market where you're already going to see some type of deal making that takes place just because of valuations, does that mean because of how we see Disney and all of the things that they could be viewed at as you just mentioned, even a telco company, is this the time for them to do more deal making? And is that why Bob Iger kind of makes sense to come back in for that deal making for another huge strategic acquisition at a more favorable price target?
Yeah, it's certainly possible. It's certainly possible. I mean, what the street knows is Netflix is a winner in the DTC business. Disney is sort of a tentative winner, right? I mean, I think people think they'll succeed. They're just unwilling to ascribe value to the business. To give you just a rough number, if you put the same revenue multiple on Disney's DTC business that Netflix gets, it's worth $45 a share for Disney stock. And then there's a bunch of other players where the street doesn't believe they have the scale to succeed. Companies like Paramount, as an example. I mean, that's where the consolidation sort of needs to happen.
Jason, obviously the street, and it sounds like you has a lot of respect for Bob Iger. And it's almost like the guy can do no wrong, right, in terms of the perception of him. Does Iger have any weaknesses? Is there anything you're worried about with his return?
Does he have weaknesses?
Is he perfect?
Look, perfect. Well, no, he's not perfect. I mean, I'll give you some examples of things where I thought he was a little bit slow. We really used to criticize the linear television business as being incredibly vulnerable. And Disney, along with a lot of other companies, would sort of push back on that and say, oh, no, it's great value for the consumer. That was clearly wrong. And so, Iger was spending a lot of his time sort of trying to fortify the intellectual property at Disney when he bought Pixar back in, I think it was 2005, and then he bought Marvel in 2009, and then bought Lucas a few years after that. That was all really designed to resurrect the studio and infuse IP into the parks. And kudos to him, that's why he has a great reputation. But what was happening in parallel to that was the demise of the linear business, right? And so that's where he sort of missed the ball and was sort of late to that pivot. Now, they bought Fox, and they started that pivot, and then Iger retired. And so that would be my critique, not seeing the true vulnerability of the linear system early enough to actually be a shaper in this business as opposed to responding to companies like Netflix.
Great perspective here on a very busy morning, I'm sure, for you and, of course, all Disney shareholders. City Managing Director Jason Bazinet, appreciate it.
Yeah, you bet.